Okay, well, just like with the income statement, sorry. I did forget to do something. Turn on my remote. Okay, now I'm ready. As with the income statement, you can have a personal balance sheet. A lot like we've done with businesses where we look at assets, liabilities, and equity. But for personal finance, we don't call it equity. What do you call it if you take somebody's assets, pay off their liabilities, or at least subtract their liabilities? What do you call what's left over when we're talking about personal finance? Net worth. Exactly. So when you hear people talking about their net worth, it's the same concept as equity in corporate finance. And we'll be each creating a balance sheet where you document whatever you own. You don't have to go down to like the individual sock in your sock drawer, but just in general, what are the assets that you have, especially things that are valuable? What are the liabilities that you have? Any debts? And then the difference is your quote unquote net worth. Now, it's not your worth as a human being, it's just your financial net worth. So that's what we will be working on later. And as I've mentioned before, I don't see this information. It's only for your eyes. Even when we get together on Thursday of next week with whoever's going to be in your group, which you'll decide on that day. Did you put your name on the list? Yeah. When you get together to do your group activity, you're not going to be sharing your own personal finances. The way I set it up, there's some ratios comparing your budgeted income statement and balance sheet with the actual. And that's what you're going to be sharing, those ratios, which really just shows where you are compared to where you want to be. Okay. So you can know that whatever you put on the spreadsheet is really just for your eyes. Now this first graphic I think is kind of interesting. It shows you where is the wealth in the United States. So this is average household net worth. Do it this way. Like that. So it's a little bit fuzzy and hard to see, but the darker the area, the higher the average wealth. And if you look at our region of the world, I think this looks like Monterey Bay right there, right? So we are not in the darkest region. Silicon Valley and San Francisco have a higher average net worth than Monterey County. But if you could see these numbers that, again, are kind of fuzzy, it looks like it's the darkest region is average household net worth of $1 million and up. Now that's an average. So for Silicon Valley and the Bay Area, if this graphic is right, that's saying that's the average household net worth for the entire household. My guess is a lot of that wealth is in real estate. Because if somebody bought a house in either of those areas, Silicon Valley or the Bay Area, let's say in the 70s, maybe they paid $50,000 and it's now worth $2 million. Their wealth grew just because of real estate prices, right? So that's probably where a lot of that's coming from. But it just helps put things in perspective, right? You could see other areas of the country, there aren't that many that have this really dark, high average net worth, right? There are a few pockets here and there, but mostly it's New York area, San Francisco area. That's where most of the money is. And then a lot of light areas here, right, in the more rural parts, which is really not surprising. It's kind of what you would suspect. So last week we talked about income, right? The money that comes in and then the costs that eat away at that money. But the money that you save and invest is what goes into your assets, right? So they're different things. Income is how much money you receive during a period of time, but assets are what you kept, right? Well, so one aspect of our own personal balance sheets is the liabilities section. One way to look at that is the credit score that pretty much everybody has. It's an automatic thing in our society. Our whole economy is built on these credit scores. Who can tell me this word FICO? They call it your FICO score. Does anybody know what that stands for, where it comes from? Kind of sounds like the FICA taxes we learned about back in financial accounting. Medicare and Social Security are called FICA taxes, but it's not FICA, it's FICO. So FICO stands for Fair Isaacs Company. It's a company that came up with some way to calculate how creditworthy a person is. And this company still exists. However, we don't get the FICO credit scores from them directly. We get them through 3 credit rating agencies. I think, did I list them here? No, I didn't. But it's TransUnion, Experian, and Equifax, right? Those are the 3 credit rating agencies. So what those companies do is they gather information on individuals. And if you ever look at your credit report, it's amazing how much information they have. How many people have looked at their credit report at any time? Right? Well, I'm not surprised. Having worked at the bank. So on your credit score, you will see every place you've ever lived, worked, any account you've ever had, payments that you made on those accounts, times you were late on those payments. It's amazing how much data gets collected there. And then these credit rating agencies, using whatever information they get from the Fair Isaacs Company and their own personal algorithms they've developed at each agency, God bless you, issue a credit score. So you've got 3 different credit scores, one from each of those 3 agencies. If you go to apply for a loan, the company that you're applying to, they'll probably run a credit check and get at least one of those 3 scores. In some cases, they'll get all 3 scores because they want a really good understanding of your credit worthiness. And what does a credit score really tell us? Again, it tells you the person's credit history, but it doesn't really tell you if they're an honest person. It doesn't really tell you if they're going to repay their debts or not. But it is the system that we have. And in fact, not only if you're trying to borrow money, if you're trying to rent an apartment, they'll probably run a credit check on you. Sometimes when you apply for a job, they'll run your credit score. And that will be one factor they consider in determining whether or not to hire you. And the thinking is that if you have a good credit score, you must be responsible with money and you can be trusted. And if you have a bad credit score, then you're irresponsible with money. Now, let me ask our resident banking expert, what do you think about that? Does the credit score, how well does the credit score really reflect a person's credit worthiness, in your opinion?
People like who can't get her together is like, yeah, her score totally reflects.
Yeah. So you think it's pretty accurate? People who are who handle their money better are going to have a better credit score, and people who don't are going to have a bad credit score.
Yeah.
In general. Are there cases though where somebody might just find themselves in a situation where they've got $200,000 of medical debt And even though they've been a responsible person their whole life, all of a sudden their credit scores
So
were.
those are like one-off situations, but the
Mhm.
problem is that a lot of times with those people, they don't know that they can.
Okay,
So that doesn't come into play effect.
well, here's another scenario. What if you've got somebody that's got an excellent credit score, but they're a con artist? Is that possible?
The guy I just bought a car 2 weekends ago and the guy came back. Oh, we call it
Rick?
Flip. I'm like, what does that mean? He's like, you're for sure.
Okay.
But I think
So if you need someone to co-sign on a loan for you, you know who to go
100%.
to.
Well, like, the thing is though, I think it's unfair because they, for the young people, a lot of times, like when I went to the bank for my experience,
Mhm.
a lot of times the kids would come in and I would try to take some credit. And their parents would interfere. I think
Yeah.
the parent would get a little bit of this information if their parents had that experience.
Mhm.
Like I would tell them like it's good for you, especially, because they're going to college, to start their credit so that they build like for those 4 years
Mhm.
that they're in school, be responsible and for like, no credit card. It's like, oh, because you have that credit, so you think that they can manage it, which is unfair.
Well, so credit cards, it's an interesting point you bring up, because one way to build your credit is to have a credit card or some other, sort of debt. There's so many factors that get looked at: how much debt you have, how well you've paid it off. If you've closed accounts, sometimes it works against you if you close a credit account. You would think it would actually be better, but it's very complicated. Nobody really knows the entire formula, right? It's somewhat secretive. So you can't completely game your credit score, but there are some things you can do to help.
If you have
your credit score.
I get accounts closed all the time and it doesn't affect my score because as long as you have your line account.
It is one of the factors they'll list sometimes. So number of accounts closed could be a factor that could.
I think it's more they got the charge. Because my closed accounts,
Okay.
they never come off.
Oh yeah, if it got closed because you never paid it, then that would definitely be
Yeah,
bad.
but I've had like so many accounts closed over the years and it didn't affect me because like even if they weren't. Oh, weren't too bad enough.
Mhm.
Because I opened a store card like when we lived in like say 50%, sure, no problem. But like as long as it doesn't, it's not my three things.
But
Debt affects it more.
yeah, sure. But the point you raise about should you get a credit card to establish a credit score?
Yes.
And it's a very important point because it's kind of necessary that you have some way to build your credit score. Even if you don't plan to borrow money, right? It would be really good if you're in the habit of saving up and paying cash for things, because then you're not paying interest, right? And then you tend to make better decisions when you're spending cash instead of credit. But even if you never plan to borrow money, again, if you're going to rent an apartment or apply to work at a bank, they're going to want to see your credit score. And if you don't have a credit score, you might not be able to rent that apartment or get that job. So how do you do that? You might have to open up some sort of account, like a credit card account, to establish your credit. Problem is, it's a trap, because we are the most marketed to and most indebted group of consumers, I think, that's ever existed in history. And why is it? Because when you got that credit card, it's really easy to just swipe or tap and pay for things. Then you get the bill and you're like, oh my gosh, what did I do? I don't have enough money to pay this bill, so I'm just going to pay the minimum balance. And then it just snowballs, right? Because of the interest.
Yeah, but Travis, don't you think that this generation is higher to our wages than that?
Yeah, exactly. Wages haven't kept up with inflation for the last 40 years. So
A lot of people have to want to and then in school, like You brought up medical, but I've seen more people whose credit is affected than medical.
Right, well, so, I mean, sometimes you have debt that you kind of have to go into for whatever reason. But it is a trap. There's a whole financial industry that makes money off of people being in debt. So if you're gonna go down that road and establish a credit card to build up your credit, you need to have the discipline to pay that sucker off every month in full and not let it accumulate. Did we talk about compounding interest last week? Yeah, so if you are carrying a balance on your credit card, guess what? That's compounding. Right, it's working against you, so it's snowballing in the wrong direction.
What I used to love to tell people about, because I think a lot of people get a misconception of credit. You can open a credit card and buy the one thing that you're going to buy anyways.
Okay.
A tank of gas. It's not how much you spend, it's if you make your payment on time. So all the kids that I would open their credit cards on, just buy one thing.
Okay.
You're gonna buy.
Yeah, that's a good idea.
Gas or something, and then wait for the bill, and you'll build your credit like nobody's business.
So not only that, if you're trying to establish credit, maybe set it up where it automatically pays for, let's say, your Netflix account every month.
Yes, something you
And
already-
automatically the payment is made from your bank, and there you don't even have to worry about it. It's just automatically charged, automatically paid, and then you just cut up the card and never use it.
Yeah, because
There you go.
people have a really bad misconception of how to build their credit. It's not how much you spend, it's better to spend less if you want. You're a responsible.
Just showing that you made the purchase and
It's
you paid
just
it off.
showing that you made a purchase and paid it off. That's it. Doesn't matter how much you, that I have. People- I think I told you in the other class, I had a razor who I had to report to the manager because he told the student who came in for a credit card, oh, like basically max out your card and just make a minimum payment. And it's like, that is not how to use a credit card.
Mm.
That's the worst possible thing
Yeah,
that anybody
exactly.
can do. I can't believe you even said that, but.
So I'm not the only snitch, you're a snitch too.
I put them either right then and there in
Uh-huh.
front of the customer to show that they were trying to do the right thing, or I was gonna tell the manager, because that is awful, like, I literally had to like pull that customer aside and be like, everything he just told you is wrong, 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 do not do that, like, that's
Well,
what I'm
good for
saying.
you.
When I would open a credit card for the
Mhm.
students, I would just tell them, buy one thing
Right,
that you were already gonna buy, and that's it.
there you go,
Put it to the side and make your payment, that's all you have to do,
like every month.
every month.
So, Audrey?
Yeah, I have a question. What I do is I use my card and then I'll make the payment right then and there.
No.
Okay,
No?
No, because you're trying to make payment history, so if you pay it right then and there, nothing gets like really reported. You wanna, basically, you wanna get the bill to show that you've got the bill, and then make your payment to show you made your payment on time.
Okay.
If you pay it before it hits the bill, then it's like nothing happened basically. Yeah, it basically cancels itself
Okay,
out.
so I should wait. Oh, how am I doing that, but I guess.
well, again, you might be able to set it up where your bank automatically just pays whatever is the balance on your credit card. That way you don't have to worry about forgetting.
You're only supposed to use like 30% of it to build it less.
So to not use too much of your available credit, well, yeah, I mean, I'm not sure what optimizes your credit score, because again, it is somewhat mysterious, but as a rule of thumb, yeah, the more you use, the harder it's gonna be to pay it off,
The
so.
majority of your credit score is 35% of your income and 30 or 35% is your payment history. So less is more and paying on time, and you're gonna build your credit really quickly. That's what I did to build mine, and in a year, I had already had over 700 scores.
Okay. All right, well, thank you for your knowledge and expertise.
Just so you know, it is expertise, because my credit score is 842.
Nice, that's about as high as it can get. As you see, 850 is the highest, right?
But I call me break.
So if you would like to take a look at your credit score, there are a ton of different websites you can get it from, but they all want to sell you something. The official website that you can go to and get your credit score and your credit report from each of the 3 credit reporting agencies is this one here, annualcreditreport.com. You do not have to pay. You can get all 3 credit reports. So what you might want to do is get your TransUnion report, and then 4 months later, get your Equifax, and 4 months later, get your Experian, because you can get one every 4 months for free. But again, they can be long and sometimes hard to understand. Emma maybe can help you decipher.
I would gladly help anybody who has questions about their credit.
But the reason to check it is you might see stuff on there that's not correct. There might be somebody with a similar name or a similar social, and information just got updated incorrectly. That can happen. So if that's the case, you want to notify them and have them straighten it out. Or there could be identity theft, right? Sometimes that happens where somebody gets a hold of your credit and they're opening up accounts you don't know anything about. Okay, any other comments or questions here related to liabilities or credit scores? Jordan?
Are the percents supposed to add up to 100?
These? 161. I guess not. 61. Yeah, it's way off, isn't it? Like 111%. Oops. Yeah. It's really for illustrative purposes. But yeah, thanks for pointing that out. All right. So let's talk about assets. Here are just some tips from my own personal experience on managing your assets. We've already talked about budgeting, right? Controlling your spending helps you preserve assets. The less you spend, the more assets you keep. There are apps, I think we talked about this a little bit last week. Emma pointed out there, a lot of banks help you with your budgeting. They've got software that helps with budgeting, but there are apps specifically to help with budgeting as well. And those can be useful because they can send you reminders about what goals you set and what budget you set and how you're doing towards reaching them. So another thing to think about, you know, we all make purchases and we get these receipts, paper sometimes, email sometimes, even text receipts sometimes, right? So then you think, do I need this? In a lot of cases you don't, but sometimes if you are going to return the product, it's good to have it. They might not take it back without a receipt at some stores. So for expensive purchases, you might want to make sure you do hold on to that receipt just in case you do end up returning it. If you have a business, it might be a tax deductible expense. In that case, you definitely want to save receipts because the IRS will expect to see them. If you ever get audited and you're listing all these expenses for your business, they might want to see the receipts. So you would need to keep those, at least for 7 years. After 7 years, they're not going to go back that far.
Sorry.
Okay.
Some of those receipts that you just get to ask for it. We're all on receipts.
So maybe
even
scanning them or something?
yeah, having a different kind of copy, it will happen.
Yeah, that's true. Yeah, some of the thermal ones especially, they fade over time.
Yeah, like the ATM receipts, bank receipts they give you, they put them off.
Good point.
Be able to read it.
And then some people just use their receipts to track their spending. So for me, it's easier to look, you know, on my bank account, for example, and see what I've spent. I usually don't use cash. I usually use a debit card. But if you pay with cash, maybe a way to track and see what you spend money on is save those receipts. And then every month you can take a look and figure out what you spent the money on. Obviously, you want to minimize debt. If you have to take out a student loan in order to get the education you need for your career, understandable. But hey, if there are scholarships or grants you can get, or if you could go to a different institution that's more affordable, those would be obviously other options, right? So even student loans, if you, to the point you can try to minimize those. Buying a house could be a good use of debt, but again, you really have to be careful. Is it the right time for you to buy a house? Is it the right time in general to buy a house? And then are there programs that, because there are programs out there that sometimes will pay your down payment for you. There are nonprofits and government programs where they will pay the down payment, and then as long as you keep the house a certain number of years, you don't have to pay it back. You might still need a loan for the rest of the house. But other than student loans and house purchases, I would say really, really try to avoid any debt at all. Even buying a car, if you can, save up, pay cash, not have to pay interest, right? Because that just adds to the cost. Obviously, you need to save as much as you can. I think I told you last week that the wealthiest people that I had the opportunity to work with, guys, could you stop the whispering? It's kind of distracting. The wealthiest people I've worked with, they got wealthy typically by saving and investing and working, right? They didn't take some shortcut, they did it the hard way, but it paid off over time. You might get lucky, you might win the lottery, right? You might start a business that just takes off and becomes super successful. Who knows, right? But in the meantime, try to save. Because what I found is there are basically two types of people. There are savers and there are spenders. If you're a spender and all the money that you have available gets spent, there's nothing to save, right? And it's really easy as your income comes up to just spend more. And then you keep looking for higher income, but then you keep spending more, right? So if that's the pattern, you're never going to save. So as hard as it might be, you have to build that habit. And if you can't build that habit, set it up where it's just automatic, right? Where out of your paycheck, a certain amount of money just goes into a savings account or into a retirement account or something, so that you don't even have to think about it. God bless you. Because then you're a saver. And the savers are the people that build wealth over time. And when you do start investing, or maybe you already are, but when you do, invest wisely. The basic concept with investing is you need to have a foundation, some money set aside to cover emergencies. Then you want to have some safe investments that you can access if you need to. And then some other investments that maybe take a little more risk. And then if you've got extra money that you really don't need, that's where you can afford to take bigger risks. Think of it kind of like a pyramid. So if you're just getting started with investing, don't go for the crazy risky stuff unless you can afford to lose the money. As you build up more experience in investing, as your wealth grows, then you can afford to take some of that money and use it for something that might be riskier but might have more reward. Any questions or comments? Okay. Oh, this is the compounding interest slide. Okay. So this illustrates the power of that compounding interest. Let's say at age 25, you start putting $300 a month into an account that's paying you 5% interest and it's compounding. Okay. $300 a month. This is how that money would grow. If you follow that purple line, you see how it's a curved line? That's the compounding. Because what happens is the interest that you earn starts earning interest. So it grows faster and faster. And that $300 a month, by the time you reach 65 and 40 years, is almost $500,000. Now let's think about it. Let's do some quick math. It's 40 years, $300 a month times 12 months. That's $3,600 a year. Times 40 years would be what? 3,600 times 40? $144,000 you put in, but it grew to about 450. So you had $300,000 of growth. Not bad, right? Basically tripled your money. On the other hand, let's say you started at age 35. And you're putting in $300 a month at 5% interest. It grows as well, but notice that by the time you get to 65, it's only $250,000. That 10-year delay costs you $200,000 of potential growth, right? So the earlier you start saving and investing, the better. Now, let's say you decided to start at age 40. And now, because you're waiting until age 40, you're going to put in $600 a month to try to catch up. You still don't get to that even $350,000 by age 65. So the lesson here is time is your friend when you're investing and it's compounding. Now, what does compounding look like in the real world? It is an investment where whatever you're earning is going back into the investment. For example, if you buy a stock and you get dividends, you receive the dividends in cash, well, then it doesn't compound, right? But if you were to take those dividends and buy more shares of that stock, then your dividends are earning more shares, right? And in fact, they have programs like that. So when you buy stock, you can just automatically reinvest the dividends. Or there are other types of investments as well that will reinvest your growth for you. Remember what I said about credit cards, though. That compounding is working against you with credit cards. If you're not paying off the full balance every month, you're now getting charged interest, but then you start getting charged interest on the interest, and it snowballs. So any comments or questions here about compounding interest? Oh, true. Yeah,
So you're hoping it's always up, but that's not always
correct.
your investment. You know, a lot of people that are
Yeah, we will be talking about that. This is assuming that you're getting 5%, which is possible right now to get. There are investments out there that could guarantee you 5%, at least for a period of time. I don't know if you'd be able to get that for 40 years. Now, there's a handy little rule. Does anybody know about the rule of 72? No. So this tells you how long it's going to take your investments to double. So what you could do is, let's say somebody's offering you a 6% investment, where you're going to get 6% per year. And you want to know, how long will it take for me to double my money? You just take the number 72 and you divide it by 6, because it's 6%. And that would be 12. Your money will double in 12 years. Or, I mean, it could be any number. 72, let's say, divided by 7, it'll take 10 years. So if it's 7% interest, it'll take 10 years. And you can do it the other way too. If you want to know what percentage rate you would need for your money to double in 7 years. You divide 7 into 72 and you get 10. So it's just a neat little mathematical trick. I have no idea why it's 72. If anybody can figure out why it's 72, why that's the magic number, and explain it to me, please do. Because I have no idea. But it works. All right. Let's talk about stock market indices. I think I've shown you all the S&P 500 and how it's performed over time and how it's had a couple bubbles, right? .com and housing / Wall Street bubble, and how now we're at like record levels. I think I've shown that to you, right? No? Okay, well, so this is the S&P 500. This is not the most recent. This only goes up till December. But since December, it's continued to go up and up. And so what this tells us is how the overall US stock market is doing. This particular index, the S&P 500 index, is the stocks of 500 corporations. They're chosen by this company, S&P, which stands for Standard & Poor's. And the reason they chose these 500 corporations is because they feel like the value of their stock represents the overall stock market. So this gives us some insight into how our stock markets have performed here in the US. Again, you see this first bubble, the .com bubble. Before that, things were fairly smooth, right? There was general growth, but it was pretty flat. Then you have this huge bubble when all the investors started to buy tech stocks back in the late 90s. Started to invest in Yahoo and Amazon and things like that. But then when they realized that some of those tech companies, those .coms that they were investing in were not good investments, they started to sell their shares. And that caused more people to sell their shares, which caused more people to sell their shares. And you see the effect, the bubble burst. Then we had the housing bubble, which fueled a Wall Street bubble, because at that point, there was already a lot of cross-pollination between investments through the stock market and real estate, where they were connected. So you could buy investments through Wall Street that actually were based on mortgages and other real estate investments. So the housing bubble burst, and then the Wall Street bubble here burst really rapidly in 2008. But then you see it recovered. By 2013, we were back up to that same peak, that same all-time historic level of the S&P 500. And since then, it's just continued to take off, you know, with a couple drops here and there. We had COVID, we had oil price scares when the oil prices jumped up. We had some tariffs that were put on China that caused them to put tariffs on us. So there were some other things that impacted the stock market. But overall, we've seen our stock market really pick up. And part of that is probably corporations buying back their own stock. When they got the big tax cuts back in around, let's see, when was that? 2018, I think. Corporations got huge tax cuts, and they took a lot of that money and they used it to buy back their own stock. If you remember from financial accounting, when you do that, that pushes up the stock price. So that's probably a big part of these historic peaks that we've hit in stock market. I don't know if it's sustainable. No idea. Only the future, you know, can tell us what's actually going to happen. But this is the general history of the stock market. So would you say, let's say we were at this point right here, December 2022, the stock market had hit an all-time high and then dropped down. Is that the time to buy or the time to sell? Buy? How many people say, at this point, once it's dropped down a little bit from the peak, how many people say that's the time to buy? Okay. And how many people say that would be the time to sell? Okay, Christina, all right. And how many people say you would just hold your stock and do nothing? In general, if you hold your stock, I mean, it depends what the stock is, but stocks in general do go up over time. I mean, we can see the overall stock market just continues to go up, right? Does that mean it's always going to go up? No, there are going to be periods where it goes down. There are very sophisticated analysts that will try to figure out exactly the right time to buy, exactly the right time to sell, but even they don't get it right. There are sophisticated computer algorithms that are constantly buying and selling based on, certain formulas that were programmed into them. It's really hard to know because from this point, who knows? If, like, let's say you buy at that point. Well, what if it keeps going down? Then you're gonna think, oh man, that was the wrong time to buy. I'm losing all this money. On the other hand, if you buy here and it starts going up, then you're thinking, hey, I'm really smart. I bought at the right time. But you don't know what it's gonna be. So this is, again, the S&P 500 index. It is not the only one that is out there. There are many indices. The Dow Jones Industrial Average is a very common one. Sometimes it's just referred to as the Dow. That's based on only 30 stocks, though. So it doesn't really represent the overall economy or stock market as well as the S&P. And then the NASDAQ is a stock exchange and an index as well. Basically, the tech companies tend to trade their stock on the NASDAQ. So how the NASDAQ overall is doing tells you how the tech companies tend to be doing. All right. Yes, sir.
What do you do right there?
Well, I wouldn't buy individual stocks at all. I think it's too risky to buy stock in an individual company. I would be more likely to buy an exchange traded fund, which I'll talk more about later. But you could buy a fund that follows an index. So if you have an exchange traded fund that follows the S&P 500, then it's going to do basically whatever the S&P does. So you're not betting on one company, you're betting on 500 companies. Tends to be a safer way to go, but even that's not a guarantee because that could go down. So then what you do is maybe say, okay, well, I'll get that ETF based on the S&P. I'll get another one based on maybe the Russell index, which is for small companies. Maybe another one that's a volatility index that when the stock market is more volatile, I make more money. So you can diversify your portfolio and not take too much of a gamble, not be too worried about one investment or one stock. Yeah. And that's what financial advisors can help you do, figure out what's the right portfolio, what's the right collection of investments based on when you're going to need the money, what are your goals for that money, what is your tax situation, all that kind of stuff. So good question, but there's no easy answer.
What do you think about crypto?
Same thing. It's super risky because it goes up and down, right? Like Bitcoin went from 50,000 a coin down to 25,000. Now it's up to 60,000. So I would say only use money that you can afford to lose, especially because it's an unregulated market. So if you wanted to buy crypto, realize that you might never get that money back. Even if it performs well, what if you forget the password to your digital wallet? My wife wanted to buy some crypto. I've never bought it myself, but she wanted, so I helped her set up her digital wallet and bought some WorldCoin. I don't know if it's gonna do well or not. But interestingly, it won't let her back into the app. It's gone up pretty well from, it like at least doubled from when she bought it, but she can't get into the app. And then you try to get customer service, forget it. Like, we'll send them an email, they'll reply a couple weeks later saying, sorry, we're behind on your emails. If you still have an issue, email us again. And we've gone through that like 3 times. I don't know if it's a scam or what. So yeah, you can try crypto. Some people have made a ton of money. Some people have lost a ton of money. Okay, so where do you get your investment information from? It's always a good idea, talk to people who have invested and find out what was their experience, what worked and what didn't work, right? Because they might be able to tell you some things that work for them that might or might not work for you, but they could also tell you some things to avoid. You could also educate yourself. The Financial Times is a great newspaper for anything related to finance. I would definitely recommend checking it out. Morningstar, Yahoo Finance, Wall Street Journal. These are all websites where you can get access and for free, look up information about companies and different investments. Accountants will often be able to give you insights into investing, at least from a tax perspective. So some accountants are actually financial advisors as well. But even if they're not, they could tell you, well, here are the tax implications of this particular investment. For example, I have a friend who bought shares in a partnership. It was an investment where technically it was set up as a partnership, so she wasn't actively involved in the business. But the problem was, what she didn't understand when she bought into it is that there would be extra tax filings she'd have to do every year when she filed her own taxes from the partnership. So it added additional cost and hassle to her taxes every year. And ideally, work with a financial advisor. They have them at the bank, right? There's usually somebody.
But the financial advisor, the bank is gonna work with you unless you have a.
That might be a problem. What is usually their minimum?
Like over 100,000.
Really? Okay. And that's really true outside of the bank too. A lot of financial advisors do have a minimum. And I can understand where they're coming from because it is a lot of work for them. And if you're only investing a small amount of money, they don't really get much out of it. But it's unfortunate because that's the way our system is set up. If you want help, you kind of already have to be in a good position. And if you're trying to get to that good position, financial advisors typically don't want to help you. Jesus.
It was like the same thing. Usually, how much percent do they ask for the financial advisor?
So there are 2 types. There are commission-based financial advisors that you do not have to pay. They get paid a commission from the investment company or the insurance company. There are also fee-based advisors. They will typically charge you somewhere around 1% to manage your assets. So if you've got, let's say you have 100,000 in assets, 1% of that would be $1,000. So they would charge you $1,000 a year to manage your investments for you. And so a lot of people think, oh, well, why would I want to pay a fee? If you're paying a fee, their incentive is to grow your portfolio. Because the bigger your assets, the more they're going to get. Because they're getting a percentage, right? So if they grow your portfolio, now they're getting 1% of a larger portfolio. These commission-based advisors only make money when they sell you something. So what sometimes happens is they recommend a mutual fund for you this year. They make couple percent off of that investment. And then next year, they try to get you to switch to a different mutual fund so they can get another commission. They're not supposed to do that. It's called churning, but sometimes they do. So that's just something to be aware of. Yeah. If they're licensed, then they could lose their license. So legitimate financial advisor is not going to do that. But there are some scammers out there. It is possible. There's so many stories of people that thought that they were investing through a legit advisor and a legit company. They were even getting, even Bernie Madoff. You know, I'm sure you've heard of Bernie Madoff. He had a $65 billion Ponzi scheme. What happens with these Ponzi schemes is people are investing and they get these fake financial statements that tell them how much money they've made, but it's all fake. And only when they try to get the money do they realize they've been scammed. So there are scams. You do have to be careful. But what you can do with a financial advisor, you can actually look up their license number online and see what their history is, if there are any complaints against them. So I would check that all out.
I would say go a little bit further. Personally, some of the financial advisors that I work with,
Yeah,
so, or just try and go with a really reputable company. Oh, no.
yeah. If they're independent, you have to even be more careful. But if they work for a large institution that has a good reputation, then chances are you can trust them because they're worth it. Even if they did cheat you, as long as they were a legitimate financial advisor, there should be they should have insurance so that you got scammed, the insurance company should reimburse you for your losses. But if they are just saying they're a financial advisor, you know, and they're not really,
What's the new one, Travis? Or it's really nothing. Like maybe more towards that than the basis. I know there's a company that's active.
I don't know what you mean.
And they're licensed, but they don't really make money off of like.
You're talking about like a fiduciary responsibility?
Yeah, fiduciary. I
Okay.
don't know about the fiduciary or their financial advisor.
Yeah, these fee-based advisors, the ones that charge a fee, some of them charge an hourly, but usually it's a percentage of your assets. They are held to a very high standard that they cannot make recommendations that benefit them. They have to make recommendations because they benefit you. Gentlemen, last time. Okay, not gonna ask again, please. You can go outside and talk, but it's very distracting. See, now I don't even remember what I was saying.
Sure.
They have a responsibility to make recommendations in your best interest. Now, the laws have changed, and technically these commission-based advisors also are expected to make recommendations in your best interest. But the fee-based advisors still have a higher standard. Renee?
What about treasury bonds? How is that similar to investments compared to government?
Yeah, so actually, let's see, are we there yet? Perfect segue, Renee. If you're buying a treasury, what you're doing is you're buying a government bond from the US federal government, and you're making a loan to the federal government, which always repays its debts, right? So you can rest assured that you will get your money back with whatever interest. How do you buy it? You would buy it through a financial advisor. But the thing is, a safe investment like treasury bonds, like certificates of deposit at the bank, like a fixed annuity, I'll talk more about annuities later, and money market funds, All of those are very, very safe. It's almost impossible to lose money buying any of these investments, but they don't give you a whole lot of return. So treasuries, I don't know, probably gonna get less than 1%. Not even enough to really keep up with inflation. So very safe, but very low return. Now, if you want to get better return, you can buy some corporate bonds or municipal bonds. You want to make sure that they have a high rating, AAA, AA, A, something like that, because that tells you that there's very small chance that you won't get your money back. Because these organizations are very safe, that's why they have a high rating. Municipal bonds would be where you're actually lending money to a city or a county or a state or even school district. Those are municipal bonds. Some of them are very safe, but again, check the rating because there are cities that have gone bankrupt. There are counties that have gone bankrupt. So it is possible to lose your money on a bond. Yes, Susan?
Do you recommend dividend stocks?
It would all depend on what your goal is. If it's going to be safer than companies that don't pay dividends, right? Because if they don't pay dividends, the only way to make money would be to resell the stock at a higher price. And you never know if it's going to go higher, right? But if it's a company that regularly pays dividends, then you can expect that income, so it would be safer. So it depends. How much of a risk versus how much reward, right? So again, preferred stock, you're more likely to get dividends. Common stock, not as likely to get dividends. Real estate, also now getting kind of risky. You invest in real estate, and there are many ways to do it. It's not only buying a house, there are other ways. There's commercial property, there are real estate investment trusts that you could buy a piece of. So there are different options, but real estate, as we know, goes up and down, just like stocks do, right? There's a fair amount of risk. You could invest in commodities, even more risky. Commodities would be things like agricultural products, metals. These are things that basically come from nature. Oil would be another commodity. And their prices can go up and down pretty significantly. For example, when the economy is doing poorly, gold prices usually go up. People think, oh, the economy is doing so bad, I better buy some gold so that when the economy collapses, I've got my gold. I don't know what they're going to do with the gold, or where they're going to keep it, right? But that's the thinking. But then when the economy starts to do better, the gold prices come down. So commodities get pretty risky. Then we've got even more risky investments. If you're buying a stock and you're trying to predict what its future value is going to be, that's pretty risky. If you're investing in foreign companies, if you're buying what's called a derivative, any investment that's based on some other asset, or bonds that are not safe bonds, bonds from companies that are on the verge of bankruptcy or just leaning in that direction. You might make more money, but you might lose more money, right? And then crypto and NFTs, super, super risky. But there is the possibility to make more money. So as I was saying earlier, your financial foundation should include money that you just have in savings. It's just in the bank, easy to access for emergencies. And then as you start investing, you really want to stick with the safer investments initially as you're learning about investments and because you might need that money. But then as you build up your wealth to the point where you've got some money you can afford to lose, that's the money you could then put into riskier investments. Because you already have that foundation. Questions or comments? Okay. Oh, how many of you have seen this chart before? Okay, I cover it now in my intro to business class, but most of you probably did not see it, or maybe it's been so long you forgot if you took that class with me. I think this is really interesting. If you took $1 back in 1926 and didn't do anything with that dollar, you held it until 2009. What is that, 83 years? Yeah, 83 years. Inflation has gone up in that 83-year period to 12 times as much as it was. So what used to cost $1 now costs $12. But holding on to that dollar, you've lost purchasing power, right? I mean, there's not a whole lot you could buy for $1 anymore. So that's why it makes sense to invest, so you can at least keep ahead of inflation. Let's say you bought treasury bills, going back to Renee's question. During that period of time, these short-term government bonds have averaged 3.7%. So if that's how you invested that dollar, you follow the green line, you see how that's generally kept ahead of inflation, and your $1 would be worth $21 today. After 83 years, it's grown from $1 to $21. Although inflation has eaten away at about half of that growth, right? You can hardly even pay for an entree at a restaurant, right, with that. So on the other hand, what if you had bought longer term government bonds that have averaged 5.7%? Your $1 would have grown to $99. That's a little better. Still not really worth holding on to for 83 years, probably. What if you had invested in the stocks of large companies? They've averaged 9.6%. Oh, you have a question there, Jordan?
Yeah, so do you like subtract the inflation, like the $21, like actually worth 9?
So these, okay, so these numbers are not adjusted for inflation. So yeah, we have to manually do it. So you would say, okay, my $1 is now worth $21. Basically, I've doubled my purchasing power because of inflation.
Right.
I could buy what I could have bought for $2. So yeah, it's really not the greatest investment. Now look at this investment in large stocks. It's the light blue line. Now again, this is starting back in 1926. So stock market was booming back then. For a couple of years, you're thinking, I'm so smart. I made this brilliant investment. And then 1929, what happened then? Stock market crash. Black Friday, they called it. It crashed, right? And now you're thinking, oh, I'm not so smart. Now your $1 investment is worth maybe 60 cents or something. But if you held on to it, look, it recovered. And it's gone up, and it would have gone to $2,049. Okay, now we're talking, right? That's not so bad. Jordan.
So when it went down in the 30s, if you didn't invest your dollar, it would be worth more compared to people who did, because everything else was less. Like
If you invested it here, if you
Yeah.
bought at the low point, yeah, that would be even better.
if you just never invested it, well, yeah, that would work. But if you just never invested the dollar and then like the worth of the dollar went to 60 cents, that would make the one you have worth more than it was, right?
Well, it's not the value of the dollar, it's the value of your investment. So your investment started at $1, went up to maybe $4, and then that investment was only worth about 60 cents. So this is not looking at the value of the dollar, it's the investment itself. But what if you had invested in the stocks of small companies that have averaged 11.7%? Small companies have a higher chance of failing, but if they're successful, they have a higher chance of big profits too. So that's the dark blue line. And you see also would have crashed with the 1929 crash and recovered and crashed again. But if you'd held on to it, now it grows to $9,549. So you might think, oh, well then only invest in the stocks of small companies. Well, the problem with that is when this happens, right? Which is why diversification, buying maybe some stocks in small companies, some stocks in large companies, some government bonds, having a balanced portfolio helps make sure that there's a smaller chance of you losing money and that overall your portfolio grows, right? Finding the right balance between risk and reward. Questions, comments? Here's something interesting. You'll hear sometimes the phrase average return. Let's say the stock market, like here, had an average return, large stocks had an average return of 9.6%. That is the average. That's not the actual return. I'll show you why. Let's say you invest $100. Okay, $100. Whoops. $100. And it goes up 10%. Over times 1.1. Okay, now you have $110. Great. Now, what if it goes down by 10%? Does that bring you back to 100? We subtract 10%. Now we're at 99. So we went up 10%, down 10%. That average is 0, but we lost $1. So your average return of 0 is not your actual return, which is a loss of 1% in this case. So keep that in mind. When financial advisor tells you these are the average returns, that doesn't mean that's actually what you get. That's a numerical average. But the problem is when you go up, if you go down by the same percentage, it hurts you more because you're coming from a higher place. So a 10% decrease is more than a 10% increase. If you're, let's say, here's another example. Let's say you had $100 and it dropped 50%. Now you're down to $50. Now you have to double your money just to get back to where you were. Now you need 100% growth just to get back to where you started. So you went down 50%, but you need 100% to get back where you were. So keep that in mind. Your average return is not the same as your actual return. Okay. Now you might have heard of an IRA or IRA or individual retirement account, which actually even financial advisors will say individual retirement account, but that's not correct. It's actually an individual retirement arrangement. Now you can impress all your friends at parties and tell them you know what IRA stands for, and they're wrong. Because it's not an account, it's an arrangement that the IRS, the Internal Revenue Service, allows us to take advantage of as investors. So what an IRA is, it's a tax treatment of your investment. So that if you're putting money aside for retirement, you get certain benefits. First of all, you get tax deferral. That means any money that you've earned that you put into an IRA up to a certain limit per year, you don't have to pay taxes on it in that year. So it reduces your income taxes. You will eventually, when you take that money out, have to pay taxes on it, but that might be 40 years from now, right? So in other words, you're deferring the taxes until sometime way in the future, which allows you to invest more money now because you're paying less in taxes. If when you do take that money out in retirement, if you're not working at that time, you might be at a lower tax bracket than you are now. So even when you do pay taxes, it might be at a lower rate. Nobody really knows what tax rates are going to be in the future, but that's possible. There are limits on how much you can put in. If you're self-employed, the limits are quite a bit higher. So a self-employed person can put tens of thousands of dollars into an IRA. If you take the money out before age 59 and a half, generally you're going to have to pay taxes when you take it out and a 10% penalty. So the IRS really does not want you to touch this money. They want you to keep it there for retirement purposes. If your investments, and by the way, in your IRA, you could invest it however you want. I've even heard of people putting real estate in their IRA. Probably not the smartest idea for most people, but maybe for some people it makes sense. So it's not a way that you invest, it's just a way that you get the tax benefits of not having to pay taxes now. But if you lose money within your IRA, you don't get to write that off as a tax deduction because you never paid taxes on it in the first place. If you lose money on an investment that's not in an IRA or any other retirement account, then you might be able to claim that as a tax deduction. So that's your traditional IRA. A lot of investors, though, prefer the Roth. I'll get to that in a second. Christina?
So if you put,
Mhm.
already, that will reduce that.
Your property tax, no. Yeah, it only can benefit you from an income tax perspective, and it limits then what you can do with that property. I looked into it at one point, I thought, oh, that sounds like a really smart idea, and I realized there were so many complexities that it doesn't make sense for most people. But it is an option, it might make sense in certain situations. But yeah, your property taxes would still be the same. Okay, so a Roth IRA, a lot of people really like because the way that works, it does not give you any immediate tax benefit. You pay the taxes now, but when you take the money out in retirement, you're not going to be taxed. So if you think you might be in a higher tax bracket in the future, and it is likely the tax rates could go up at some point, then maybe that makes sense for you. But the best thing about a Roth IRA is all the growth, whatever you earn from your investment, never gets taxed. Remember we looked at that curve and how if you start investing early, you could have hundreds of thousands of dollars in growth. Can you imagine that never getting taxed? Saves you a whole bunch of money, right? So that's the nice thing about a Roth. So if you're considering opening up an IRA, you might think about which one to do. And you can do both, actually. You could put some money into a traditional IRA and some money into a Roth.
You could do both, so like,
Yeah.
because I know with the Roth IRA, it's only a couple thousand that you can put in. The
I think
limit.
it's around 6,000 or 7,000 a year. So yeah, and then there are income limits as well. But that limit applies to both.
Well, let's
So you could put maybe 3,000 in one and 3,000 in another.
Oh.
Yeah.
Limit applies to both.
But if you have a 401k at work or other retirement plan, you can do that and an IRA.
You should actually go check your 401k because I had a Roth IRA and I did not know that part of that they contribute. even though I wanted a Roth IRA.
Okay.
That's all I signed up for. The contributing money automatically went to a traditional IRA. Like we say, the tax. So when I took my money out, they're like, oh no, you have two accounts. No, I don't.
Interesting.
Yes, you do. Well, we'll start all over.
Yeah, interesting. Okay, so let's talk about 401ks. You might have heard of those. They're very common. These came about, I would say, because a lot of companies said, you know, we're spending too much money on pensions for our employees. Let's come up with some other type of retirement plan where it won't be as expensive for us as the employer. Let's come up with a 401k. That's from the tax code. That's where the name comes from. But let's come up with this retirement plan where the employee puts money in, we might put some money in, but then if the investments don't perform well, it's not our fault. Because with a pension, the company had to hire a professional pension manager that would make sure that that money grew. With the 401k, that responsibility is on you, the employee, to decide how to invest it. So it shifts the risk off of the employer to the employee. There are variations. If you work in government, instead of a 401k, you might have a 403b or a TSA. But the basic idea is they are a lot like an IRA. They give you certain tax benefits. They have higher contribution limits, though. You can put a lot more money into a 401k. And as I mentioned, employers will sometimes match your contributions, which means they're giving you extra money. So let's say they tell you, if you put in 6% of your paycheck, we'll put in 4%. Okay? You're putting in 6% into your retirement account, and they're contributing 4%. Great. That's just extra money for you. There are certain conditions. You have to stay with the company a certain number of years, and of course, it's for retirement. In some cases, the company might allow you to take a loan against your 401k or to use it for certain health needs, or there might be some situations where you can access that money, but in general, it's supposed to be for retirement. So what are the downsides of these 401ks? Well, there are costs involved. The 401k provider charges fees. Usually the investments that you can choose in a 401k are mutual funds, basically where you're buying into a fund that's made up of stocks and bonds, which is kind of nice because it's already diversified for you. But the thing is, how do you know which ones to buy, right? If you don't have a financial advisor, then it's kind of hard to know sometimes. And there's no guarantee they're going to perform. And guess what? Those mutual funds also have fees. So that can eat away at the growth of your investment. Also, if you leave your employer, you have the right to take that 401k money out of there and roll it over to an IRA, and then you can invest it however you like. If you leave it there, technically the employer is supposed to protect it. They have a fiduciary responsibility, meaning they're responsible for your money. That doesn't mean they're responsible to make it grow. They're just responsible to make sure it doesn't get stolen or spent, right? But what if your employer goes out of business, or is hard to work with, or it's involved in some big corporate scandal? You might have a difficult time getting that money. So I would generally recommend, once you leave an employer, transfer that 401k out of there into an IRA. Then you have control. Okay, so bottom line, if your employer offers a 401k and they will match your contributions, take advantage of that, because it's free money. As long as you can afford to put in whatever percentage, You're getting that free money from them. Questions or comments?
I think, then you should increase your. Like, that's where they lose.
Oh, I see. That's a good point. If you get a promotion or a raise and your income went up, well, if you're contributing a percentage, you're automatically going to be contributing more, right? I guess it depends how it's set up.
What I like to do is they have retirement calculators, you can go online and do that.
Okay.
You make sure that it is lacking.
I see. If you're trying to maintain your same income level in retirement.
Yes.
Okay. Well, other questions or comments, Jahara?
So if you want to do an IRA, would that be through your bank or different?
You can get an IRA through your bank or through a financial advisor. I think you could probably even do it online through like an E-Trade or Schwab kind of account. I imagine I've never done it that way, but I think so. All right, so that is the entire presentation for today. Let me show you the next part of the spreadsheet. It's going to be similar to what you did the other day. Actually, I think I will stop this recording.